Mark, let's talk about the markets in 3 minutes and start with China. We saw weakness in Chinese stocks, as you pointed out, weakness in the currency as a result of some of the data and taking some time to digest the rate cuts we've seen. Then we saw a bit of a recovery, but still in negative territory on Chinese stocks. And we don't see much of a bounce in Chinese stocks on the back of this stamp duty news. What do you make of the price action here?
So probably what's most interesting on the price action today is how little movement we have seen all day. It's been just a tremendous day of news flow, and it's not come all at the same time. We had that MLF cut first thing. That should have been really good news for stocks. It did not impact. It correctly flagged that the data would be really poor. Then the data was even worse than we imagined. How do we counteract those two things, or how do we counterbalance them? Then we just kept on getting negative news flow in the property sector, but it's all kind of priced. And then we got that positive news later on that they're considering this idea of a stamp duty cut for stocks. I should emphasize they're considering. It is not a new measure yet. That has caused the losses to pair gains. But we're really seeing a really quiet movement. Now, what's interesting is, over the past month, Chinese stocks have still outperformed US stocks. They're just about ticking into negative territory. But in fact, given this stamp duty headline, they might again be positive over the past month. They have not been underperforming the rest of the world despite the news flow. People do not know how to interpret this at the moment. We're just getting so many announcements on policy, which there's no real delivery on. We're getting a very clear picture that the economy is an extremely tough place. But remember, this is a tough place for an economy that should be growing at over 5%. So does that mean that we're going to get years of 3 or 4% growth? That's still way faster than any G10 country. People are trying to work that out. What I think is most interesting is the price action continues to be incredibly resilient, even though we are not getting positive news. And that, to me, is probably the biggest takeaway.
OK, another theme of the week has been the higher yield story, and the higher real yield story then, Mark, really catching some by surprise, no doubt. A 14-year high on 10-year real yields. What's the broader impact of this development?
I think this is a really, really big impact across assets. It's hard to know what all the factors are going to be. I think one thing that's really important is at the moment, short-term it's supporting the dollar and it's weighing on emerging markets. I think the reality is we're going to be moving into a backdrop of where we have sustained higher real yields. We need that to be the case because we've moved back into a world that we've not been to for at least 20 years and arguably much longer, where inflation's the real threat. There's no threat of deflation right now, and we need sustainably higher real yields. So I think the world has to adjust to the fact that they're going to continue going higher from here. What is the true knock-on to other assets? I'm not really sure, but I think one of the things that people are coming around to, maybe not partially linked to the real yield story, is the fact that when it comes to treasuries, most of the market guests we've had on this year, all year, have been talking about buy duration, time to buy duration, near the end of the cycle. I think people need to realise that it's not just about economics there, it's demand and supply, or maybe it's a different part of the economic market to think about. There's a lot of supply to come into the treasury market in the coming years, and there's decreasing amount of demand for them because we've taken out central bank buying. And I think there's the natural hit is for yields to keep on going higher from here.